Michael McCarthy from Moomoo. Welcome. It's great to have you.
Thank you, Peter. It's good to be here.
Michael, markets have been a roller coaster. They usually are, but not to the extent that we've seen over the past few weeks. Can you break down for us how you're seeing it as an industry veteran and as the CEO of Moomoo? How are you seeing markets at the moment, and how are you reading the trend?
Peter, there's no doubt we're in the midst of a financial crisis. I've lived through quite a few of these now, Peter, having been around for a while. And the good news is it's not the end of the world, but it sometimes feels like that. And the selling that we've seen in share markets in particular has been very concerning for investors. But I think it's important to remember the context, how we came into this. After the election of President Trump in November, markets took off. Now, they're already stretched. They're already at all-time highs, and the valuations were astronomical. And yet they went higher. And so we got to a stage where markets were euphoric. I think that's the only way we can describe it. And remembering that saying that goes back more than 100 years, bull markets are born in despair. They grow on skepticism, they mature in optimism, and they die in euphoria. So I would argue that the markets always needed the correction that we've had, but President Trump then conveniently, having sent the markets into euphoria, provided the trigger for the correction we had to have, and we've certainly seen that.
So do you think the tariffs are an excuse for the market, or is there something systemic and that's going to change the way business is done going forward?
I think the markets were vulnerable, and the negatives of the tariffs became more apparent because of that vulnerability. That's why they were such an effective trigger. If we'd had a benign environment with unstretched valuations, I doubt they would have had such a dramatic impact. But that double threat to lift inflation while slowing growth really got under the skin of the market.
Explain to someone who doesn't understand the stock market that sophisticated enough how tariffs impact a stock trading on an index. What is the financial consequence? How does it impact earnings, which then impact share prices?
Well, there can be direct impacts on companies, of course. So if the goods that they're importing to manufacture are subject to tariffs, then their costs go up immediately and they have to deal with that. Either they eat that and make less profit, or they increase the prices for consumers. And that's generally what happens when it comes to tariffs. So for any company, there can be direct impacts, but there are also indirect impacts. And that's what we're so concerned about in Australia. It wasn't so much the goods that we sold to the US that had tariffs put on them. It was the tariffs put on Chinese goods in particular, and the fact the Australian economy is interconnected with both the US and China. And it's that slowing effect. The effect of introducing tariffs is like throwing sand in the gears. It makes it harder for the machine to run, and the machine runs slower and less efficiently. And that's what's happening with economies because of tariffs. They're slowing down. And at a time when growth is, well, a little shaky, that's bad news.
You've seen a lot of market ups and downs, right? You've seen the financial crises in Asia, the dot-com, so on and so forth.
I was there in 87, Peter.
Tell us the major ones that you've seen, and where Trump tariff sits in that. Is it as bad? Is it amongst the worst? Or is it not as bad as what we've seen?
Well, I did a bit of a study, right? And I had a look at the Australian dollar versus the US dollar this century. And one of the reasons for that was the Aussie dollar was at historic lows. It had touched 60 US cents after the tariffs were introduced. And that was only the fourth time this century that's happened. The other three times were the COVID sell down, the GFC in 2008, and the tech wreck in 2000. So the Aussie is a great barometer of global sentiment. And when it touched 60 cents, I think it confirmed we're in a full-blown crisis. Now, 3 years into my career, I experienced the Black Monday crash of 1987. We had the credit crisis of 94, the Asian crisis of 97, and that brought us into the new century and the tech wreck that kicked us off in September 2000. So I've seen plenty of them. Now, of them, 87 was devastating. The market more than halved in a matter of days. It was the biggest sell down I've ever seen. It remains that way despite the fact it was the furthest away in time. But I think every crisis is different in its own way, and we're seeing that today. The big question for a lot of investors is how we'll recover from this. Will we see a V-shaped recovery like we did in COVID, or will we see a long, slow, drawn-out smashing of the markets? And that's my concern, Peter. After the longest bull run in modern history, we might be in for the biggest bear market we've ever seen.
Wow, that's a big call. the last few times the Aussie has hit that 60-cent range, it's bounced off it, right?
Yeah.
If you go back to COVID, the dot-com crisis, and the other one that you mentioned, that tends to be the capitulation point, right? At which everyone kind of gives up. The front page of the newspapers talking about it going to 40 or 50 cents. And, all your friends and cousins start calling you and saying, should I change money? Do you think it did bounce? It has bounced.
It has bounced.
Do you think that bounce continues, or I want to go back to that point where you said that this could be a deeper downturn?
Well, the move up to 63 cents is very encouraging, 63 US cents now for the Aussie dollar. So that bounce off 60 is an important sign. And we have seen a bit of a turnaround in important industrial commodities like oil and copper. They've both rallied in the last two sessions after being under extensive pressure. But bond markets have still not responded very well to the recent changes, and gold has hit more all-time highs in the last week. And that tells us there's still a lot of concern and a lot of desire for safety amongst investors, reflecting fear about the outlook for shares, at least in the short term.
Do you think Australia comes out of this again as the lucky country? Or do we have some vulnerabilities that have finally been exposed?
Peter, I think the ability, when the markets get really bad, to duck off to the beach and have a swim in the ocean means it will always be the lucky country.
Of course.
But to some extent we already have been, because the NASDAQ was smashed by 25% to its lows. The S&P 500 fell 20%, but the Australian market only fell 15%. Now, that's partly because we didn't participate in the rallies as much because we don't have a stronger presence in tech stocks, which are what led the rallies around the globe. So it's reasonable that we should outperform when the markets are correcting. I do think, though, that we're in a very good position. Being only 2% of the market has its disadvantages, but it also has its advantages. We're not anyone's target. We can sit quite comfortably between the major powers, and we do. Our major trading partners are China, Japan, the US, and Europe. So we can sit between all of those major powers without changing the equation. And while we can continue to bob like a cork on that global sea, I think Australia will be okay.
There's a famous gif of Homer Simpson drifting back into the hedges, standing back. It feels like Australia's doing that at the moment. We're just drifting back, holding on. And I think one of the best things to have happened is we don't make anything. But the fact that we don't make anything or manufacture anything anymore means that we probably haven't been hit by tariffs as much as other countries that have a manufacturing base. Where do you see Australia's place in trying to negotiate its way out? Or do you think we just sit there and bobble along and wait for this to blow over?
I think the important thing here is not to make new enemies. We're never going to agree with every nation on everything they do, and that's reasonable. Every nation should expect that. At the same time, we don't have to be offensive or provocative in any way. And as a smaller nation, I think that would be a more sensible course for us. So I think, yes, fading into the background, nothing to see here, might be exactly the right response for Australia as a nation.
Tell me a little bit about for those, I know you, but for those that don't know you, your career. I know how much you love markets, the thrill of the markets, the taste of the market, the uncertainty of the markets. Give us a little bit of an insight as to kind of what that means for you as a CEO of Moomoo, and where you find stock trading, stock broking at the moment in the marketplace, given millennials, tech, and all the other innovation.
Oh, there are a couple of huge trends in share markets at the moment, Peter, that are worth remarking on. And some of them are very long-run trends. So the trend towards ETFs, which began in the early 1990s, is now at fruition. And at Moomoo, obviously, we keep an eye on what our customers are interested in. So we track the most popular stocks. And of our top 20, it's quite common that 10 of them will be ETFs.
Wow.
So the rise of ETFs is very important. The other big factor in markets is the democratization of markets. Now, we first saw online trading in the 90s, and there were some big names that went in early and created what was access that had never been available to retail investors. And that was a very important development. But unfortunately, a lot of those early innovators are tied to big institutions and the big IT systems that come with them. And when a newer group of tech-savvy online providers started emerging in the late 2000s and early 2010s, they were left behind to some extent. And a lot of them had their lunch eaten. Now, I would argue we are in stockbroking online 3.0.
Wow.
We're in a new world of AI-enabled technology. The tools are available. The strength that's available to individual investors is extraordinary. And it's one of the reasons I joined Moomoo. The first to use AI on their platform. The technology is the leading part of this business. And it's the technology that really offers power to individual investors. And it's not just the ability to transact, it's the information that comes with that, whether you prefer charts or you like fundamental information, whether you trade earnings reports or macro global events, whatever it is, whatever your approach, you can find it on the Moomoo platform. And that's why I'm at Moomoo.
I remember when I started in the markets, everyone used to congregate at the stock exchange building on Bridge Street.
Yes.
They'd have their newspapers open and they'll share tips with each other. And then it became glorified research, and eventually it became forums. And now it sounds like AI is the tool that stock investors are using to do their research. Is that fair when you talk about AI features, or do they go beyond just stock screening and investment ideas?
Well, it's certainly a fair reflection, although I must say there would be some users who aren't aware they're using AI.
Yeah.
AI is just algorithms that have developed to do certain jobs. So when an algorithm presents to you the earnings report from Apple in seconds after it's been delivered in the US, you don't even notice the AI that's been employed to do that for you. So I think a lot of people aren't going there because of the AI. They're going there because what the AI does, that instantaneous information, the depth of information, the ability to find whatever it is that those investors favour. You know, investing is an individual pursuit, and everybody has to make their own decisions. So we don't try and prescribe one approach for everyone. We recognise that there are many different ways to be successful in the markets, and we give our investors the choice as to which AI-empowered tools they want to use.
What's the biggest mistake to avoid for someone that wants to deploy money in the markets given the downturn, for someone that sees opportunity? Given your experience and your tenure and your vantage point, what's the biggest no-no?
There are a couple that come to mind, Peter. I hope I can give you more than one if that's okay.
Yeah, that's fine.
First one, never fall in love with your positions. Right? Some people come to admire a certain stock or the people who run that stock, and they fall in love with it and they hold it for far too long. So the important thing is that's part of a bigger thing, and that is to acknowledge when you're wrong. Before I buy a share, I always say, well, at what share price would I say, I've got this one wrong, it's not doing what I hope for?
Yep.
And that is my stop loss point. And if the stock gets to that point, I have to use discipline to sell out of that stock because the market's telling me I got it wrong. None of us can see the future. We can only make the best decisions we can with the information we have right now. And that means, inevitably, some of our investment choices will be wrong. And people who recognise that early and cut those losses early will do very well. Peter, the key to successful investment is simple, and it can be said in 4 words, right? And that is to run profits and cut losses. And if you can do that as an investor, you will make money in the markets. There's just no two ways about it. But it's easy to say, a lot harder to do.
How much is enough to lose? So if I'm buying a position in company A and I do set my stop loss, where should I set it? Is it 20, 30, 40%, 50%? What do I use as my I got it wrong point to then walk away from a position?
Well, the answer to that depends on you and your goals in the market. Are you in for the long haul, or are you looking for short-term profits? If you're in for the long haul, you might have a greater tolerance for positions that go against you. Whereas if you're only in for the short haul, you might say, right, 0.5%'s enough.
Okay.
It also depends on how comfortable you are, right? How much can you stand? How much can you lose in the market and still sleep okay at night?
Yeah.
So these are individual answers. A rough rule of thumb that a lot of traders use is 1 to 2% of the value of their portfolio.
Okay.
I think that's very aggressive. In investment terms, one of the greatest tools we can all use is diversification. And quite often for diversified investors, it's more important to look at the overall portfolio performance rather than the performance of the individual stocks.
Perfect. Great advice. Thank you very much for sharing. These are kind of the common ones. So I think it's very good to get that perspective. Michael, last question. What have you learnt as a leader about yourself? And I'll overlay that with what have you learnt about yourself as an investor also working in the investment markets?
Well, Peter, I started on the ASX trading floor in 1984 as a bookings clerk, and I graduated to become an options trader. And options trading can be very exciting, but there were plenty of times when it was pretty dull. And I'll never forget standing there, leaning against the desk on the ASX options trading floor, and another trader turned to me and he said, you know, Macca, I really like trading because it teaches you so much about yourself. And I think that's true of leadership, and I think that's true of investing as well. If you want to know how tough you are, how disciplined you are, how well you can deal with adversity, become a trader, because the markets will dish all of those things out to you. One of the greatest risks, there are two times, Peter, when traders and investors are in big danger. One of them's obvious, right? After a big loss, right? We're off balance, we don't make good decisions. The other time's a little less obvious. The other time that everyone's in danger is after a big win, because we also get off balance. We become too confident. We overcommit to positions. So big wins and big losses are red flags. I guess that's one of the biggest things that the markets have taught me about being a person.
How do people find out about Moomoo? And if they want to explore it, if they want to kind of use it for their own investments, what's the best way for them to find it?
Well, if you search for Moomoo Australia, we've chosen a distinctive name for a reason, Peter. I must admit I do get some grief from my mates about it, but you won't mistake us for anyone else. So if you search for Moomoo Australia, you'll go straight to our website, and that's a good place to start exploring.
We'll also put the links in the show notes. Thank you very much for your insights, Michael. Thank you for taking time out of your busy schedule to come and give us your perspectives on the markets. And I'd love to get you back throughout the year, you know, whether the markets are higher or lower, to get your pulse and to share with our viewers kind of how you're reading the markets. But thank you very much, and we wish you all the best in the new role.
Thank you, Peter. Sounds like a plan.
Thank you.